Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. Welcome to this week's episode of the Prime Property Finance Podcast with myself, Gareth Morgan. For those of you who are seeing any clips, you'll see that Movember is going really strong. The TASH is growing. It's popular in some areas, but unpopular in other areas. So we remain to see whether it'll stay past the end of the month. But there's been other big news, not just the moustache. Obviously, the budget was this week. And in this episode, we're going to deep dive into that and just get a high-level view of those changes and how that impacts property investors. So, please have a listen and let us know your thoughts. So the budget has been and gone, and in this episode we're going to kind of recap on our thoughts on what's happened, the speculation around what was going to happen, some of the things that were going to come in and what didn't, and whether it was good, bad or indifferent. So ultimately there was a couple of interesting things that were being bandied around about national insurance being levied against rental income. That was probably the key one that was interesting, and there was obviously some VAT thresholds that would affect some businesses and investors. Now, neither of those things happened, which was good. So that was definitely a positive that's come out of it. Overall, the sentiment seems that it was a pretty negative anti-growth budget. It was one of the biggest tax grabs in history, according to some stats that I've seen. And so it was very interesting to understand that a little bit better and what those impacts are going to be. So when the government have been saying that they're going to be pro-build and pro-growth, that's been quite the opposite. There was nothing in there that I could see that was pro-growth at all. All it was raising taxes effectively. And whilst they weren't raising income taxes, they've frozen a lot of bands, in which case it's going to send people into the higher tax bands. They've reduced some of their ISA allowances, which affect savings. And so those are the kind of headline pieces. But from a business perspective, in terms of landlords and property investors, the key changes from a landlord perspective are around personally held properties. So from April 2027, so just under 18 months from now, that landlord tax is going to rise by 2%. So what that means is currently, if you have any properties in your personal name, they are taxed at the current income tax bandings, which are 20% for the basic rate, 40% for the higher rate, and 45% for the additional rate. What that means is from next time, the property income is going to have its own banding, which is going to be 2% higher, which is basic rate of 22%, higher rate of 42%, and an additional rate of 47%. So ultimately, that means tax is going to rise again for landlords who have been affected by Section 24. And therefore, the conversation for this really is going to come around the same conversation that we've already been having is anyone who owns properties in their personal name, it's becoming less and less viable. So two things are going to happen. One likelihood is that rents are going to go up to cover that additional cost, because they pass those on to the tenants if they can in their market. And secondly, it might force some extra people to leave, which will again impact on supply and demand, which will mean if there's less supply, then the rents will go up. And also it just recaptures the conversation that we've been talking about for a long time now around whether you should incorporate. So if you do have personally owned properties, should you incorporate them into a company because of the tax advantages? Now, it's not all straightforward because on the flip side of this, savings and dividend taxes have been increased. So dividend taxes have been increased or as of this April April 2026, by 2%. So when you have rental income in a company, at the moment, you can offset 100% of the rent mortgage payment, which is a better position, and then you pay corporation tax on the profit within the company. But then if you want to draw the income out of the company for your personal use, then if you're taking that out for your dividends, then that dividend rate is going to increase by 2%. So it's a pretty similar cost in terms of tax that's going to be borne. But if you've got other income outside of property, then you will use up those allowances first if the properties are used in your personal names. So you might pay a higher proportion of that tax, and you don't have a choice about paying that tax if it's in your personal name. Whereas if it's in a company and dividends, if you're already in the higher brackets, then you may not choose to draw those dividends. You can leave them in there for the future, in which case you won't pay the higher rate. So you've got a little bit more flexibility around what you can and can't do in terms of drawings. Now, bearing in mind, I have a caveat here, we are not tax advisors, we are not accountants. This is just us looking at the data. I'm not giving any advice. We're just seeing that what we're seeing and the potential pros and cons from it. Now, one of the big changes that didn't happen, there was nothing in terms of stamp duty, land transaction tax or anything like that. So that stayed the same. One of the big ones was annual mansion tax. So they've been toying with this and wondering how would that look. So that was probably the one that nobody really knew what it was going to look like. So it's unclear what exactly it's going to be. But on any homes valued at more than £2 million, they're going to likely to have an additional council tax. And that's going to be anywhere from £2,500 to £7,000, depending on the valuation. And that's going to be our understanding, based on the VOA valuations. And then another one that will impact property investors is a potential visitor levy on short-term lets. So I know in some countries in Europe, you pay a local tax when you go on holidays, and that has to be paid in cash when you arrive. You don't pay it to your travel operator. And this sounds like something similar. It's under consultation. It's not come in yet, but that is something to keep an eye on. Ultimately, taxes have overall be going up, in which case the majority of businesses will try and pass those on to the consumer, and in which case that will cause higher prices. So whether that has any effect on stabilising inflation, it remains to be seen. So what are these impacts for landlords and investors? Well, ultimately for personally owned buy-to-lets, then net yields are going to be compressed because you're going to have more tax, and without raising any rents, then you're going to be in a worse position. So that's something to consider. Obviously, I mentioned that the tax on homes valued at 2 million or more. So again, that may impact low yielding stock and whether people decide to keep those or not, because they're already low yielding, depending whether they may see value in restructuring the portfolios. The company versus personal conversation, structural reviews, huge topic of conversation. And in the broader market, there hasn't been the stamp duty changes. So that may give an opportunity now for people who've been sitting with cash ready to buy, waiting to see what's happened in the budget, and now whether we might see a little bit of stimulus in the economy again, in the housing market. So from a landlord and investor's perspective, I think it really now that what the key things that you need to do is review your portfolio for the next couple of years. You need additional stress testing based on additional tax that you're going to pay, understanding whether you are going to switch from personal to a limited company if you have got some personally held properties. Your finance strategy needs to be more realistic and making sure that stress tests are carried out. And then from a capital expenditure point of view, with the renters reform bill coming in and the EPC changes due to come in, is how much cash have you got in your coffers to make any of those changes. So this is a really high level view. Hopefully that's been useful to run over it. But we are going to be doing a deep dive next Wednesday, the 3rd of December at 7 p.m. And we're going to be running a webinar, and we're just going to go through some of these impacts, but what they look for, mostly towards development and investors, people who are doing new build developments, conversions, and things like that, where, how are they impacting the 12 to 18 to 24 months ahead, and then what are the pros and cons we'll see during the market, and these impacts this will have on the market, and how you may want to amend your investing strategy or your overall due diligence, which is probably the key part of any deal right now, is how well you carry out your due diligence. So hopefully that's been helpful. Please come and join us if you're interested next Wednesday, the 3rd of December at 7 p.m. There'll be a link in the show notes to register, and hopefully we'll catch up soon. Other than that, bye for now. Thanks for listening, and hopefully you got some value from that. There was a quick rundown of the budget in 2026, and hopefully you understand it a little bit better now if you haven't had a chance to have a look at it yet. But yeah, if you know anyone, as always, that might get benefit from it, please send it over to them, like and share. We really appreciate the support. And like I mentioned, we are running the webinar next week, and if you'd like to jump on, then we'd love to see you there. So catch you soon. Thank you very much.